It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a Bank Information. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. Today I'm going to do my best to answer probably the number one question that I've been receiving from prospects and clients both, and in light of the rapidly increasing interest rates with the Federal Reserve. Now, first of all, so this is going to be very important for you to listen and understand better if you are considering a personal bank policy, if you already have one, or even if you have a cash value policy, understanding how its cash is going to grow going forward with this higher interest rate environment. If you're looking at accessing funds from it, again, whether you've gotten it through myself, your personal bank, or elsewhere. So this is going to be a very, very valuable show for, again, better understanding and what to expect going forward with a rising interest rate environment, whether you're looking at it or already have one or looking to expand into another one. Okay, so let's go. First of all, real quick review. Setting up a Your Personal Bank policy, or the Your Personal Bank concept, I should say, is a two-step process that involves setting up a high cash value policy. Now, many people have these type of policies already, and if you have one already, you can convert one or use the existing one. We can show you how to increase your rates of return, increase your cash efficiency without any costs, taxes, or anything like that. So we can increase your growth rate, okay? So if you want to learn how to do that, contact me at 866-268-4422 or yourpersonalbank.com. Again, 866-268-4422. Now, we set up the policy to grow cash, to earn dividends. And we've got companies that have been paying, right now are paying between 5.75 and 6% dividends. Never missed a dividend, literally since before the Civil War. So they pay dividends through every year, Great Depression, both World Wars, even including the Civil War, never missed. The historical average, I shared with you, the current rates, this is important. The current rates are 5.75 to 6%. Historically, the rates have averaged around 6.5 to 8%. In other words, the better dividend-paying companies, the ones we recommend, were all paying 7-8% in the late 90s and early 2000s because we were in a normal interest rate environment. After 08-09, the Federal Reserve dropped rates to the floor, in fact, and stayed there for about 12 years. In other words, we had the lowest interest rate environment in the history of our country for the last over 200 years. This was the lowest interest rate environment ever for the longest period of time ever. Okay? So the fact that these companies are still paying 5.75 to 6% today in 2022, after a dozen years of the lowest interest rate environment ever, is incredible because dividends are profits of the company and are highly interest rate sensitive. The fact that the Federal Reserve is aggressively increasing interest rates. Every single company, basically, I've talked to has stated the same thing. Dividend rates are going up, and they're probably going to be going up rather quickly starting this next year. Insurance companies they set rates annually. Okay? So we are looking at a strong increase on dividends going forward because of the strong increases, the historically aggressive increases of the Federal Reserve. We are witnessing one of the most aggressive, fastest increase in interest rates in the history of the Federal Reserve, over 100 years. So, folks, one of the things we're dealing with is we are in uncharted waters. Now, what is that doing? The rapidly increasing interest rates. Why is the Fed increasing them so quickly? Well, the reason is quite simple. Inflation is at 40-year highs. We are dealing with historical high rates of inflation for many reasons that I've talked about in previous shows. So that will continue for some time until inflation is alleviated. What's going to alleviate inflation? I've stated this many, many times. Forget the politics. Energy prices have to reduce, which means energy supplies have to increase. Until our administration changes their energy policies, we will have higher than average inflations. That is just a fact. Also, the government, by spending more money than it needs to, by overspending more dollars in the system, creates more inflation. So the two things that need to happen to reduce inflation is energy policy needs to change dramatically, needs to increase energy supplies, and so far we're seeing no indication of that by the current administration. Two, the federal government needs to spend less money, quite a bit less, folks, and we see no indication of that yet either. Therefore, from an economic standpoint, basic economics 101, we will have higher than average inflation until those two things are resolved. And I've seen articles and by some very credible economists and the Federal Reserve themselves now stating the Fed by itself, in and of itself, cannot stop inflation. In other words, they can raise rates through the roof, but inflation will continue until spending is curtailed. It's going to take both, folks. So we're in for a ride, probably for a while. I don't mean to be a downer, but I just want to give you the facts. Now, remember the first step, the first key here is we're setting up policies to earn dividends. Dividends are at historical lows and will be increasing as we go forward. So your rates of return are going to increase, guaranteed, insured, tax-free. That's a good thing. The other question I get asked all the time, I want to clarify this real quick. You talk about using the bank lines and all that stuff. I'm going to get into that in a minute to access the funds. What if you just want to let the money sit and grow? Folks, you can do that. You have the option. Put it in, let it ride. You have access to 50 to 85% of the money day one. And having money sitting in cash or in the bank earning little or no interest is financially foolish. With 8% inflation, according to the government, frankly, double-digit inflation, real inflation, that means your money's losing double digits just sitting in the bank each and every year until this inflation gorilla is tamed. At least if you're earning 5.75 to 6%, it's not keeping up with inflation, but you're not losing so much. And you have the liquidity to grab the money and take advantage of opportunities when they present themselves. I believe that is powerful. Again, you can have money growing right now at 5.75 to 6%, insured, guaranteed, tax-free, with high liquidity. And then you want to grab it and take advantage of opportunities when they present themselves, because I believe that will happen too. At some point down the road, you can take advantage of that. So people ask me, what am I doing with my money? Piling it into this to earn and waiting for opportunities. That's my best recommendation for you at this point. Now, let's talk about step two. Step one, remember, set up the policy to earn dividends safely, guaranteed, insured, tax-free. Now we want to access funds. We want to access money. So what we usually do is we recommend setting up a bank line of credit. The cash in the policy is the collateral for the loan. This works on the identical same principle as home equity lines of credit, for example. Most people are familiar with those. If you set up a HELOC, a home equity line of credit, the collateral for the loan is the equity in the property. If you set those up, there's no points, there's no costs, there's no fees in both cases. In the HELOC, the disadvantage is if you borrow from it, you have to pay monthly interest. With a bank line of credit using the policy as collateral, the cash in the policy as collateral, there's no requirement to make the monthly payment, the interest payment. Certainly you can, and if you can, I encourage people to do so, because then you're borrowing money at simple interest rates. Remember, if you're paying the interest each month, you don't owe the bank any more money, right? So you're borrowing at simple interest because you're borrowing the money from the bank, not the insurance company. The money is at the insurance company earning dividends. It's all there and earning compounds. You grow money compound, insured, guaranteed, tax-free, access through the bank line of credit. If you pay the interest, you're borrowing at simple interest rates, which means the amount of money you have available each year increases even more. Now, why this works, you get positive arbitrage. And this is why we're going to talk about further and get into depth with this. So I'm going to really encourage you to stay tuned because interest rates are moving. But right now, as we speak, as I stated, the dividends are 5.75 to 6%. The borrowing rates are 3.5 to 4%. So in other words, if you're earning, to keep it simple, let's say you're earning 6% dividend, and then your borrowing rate is 4%, which is the worst case scenario, folks. I'll tell you why in a minute. And you access the funds from the bank and spend the money. You're earning 6, you're getting charged 4. What's your money doing? The answer is quite simple. The answer is you're keeping the difference, the 2% difference. And if there's one thing I always share with people, there's one takeaway I want you to take away from this, is that's on money you spent. Contact me for more information and stay tuned in the next segment. Contact me at 866-268-4422 or yourpersonalbank.com for more information.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. Again, today we're talking about if you have, are looking at doing a personal bank or have one, even with us, or you have a policy, a cash value policy, and you want to know how the increasing interest rates are going to affect these, you need to stay tuned to this show. I'm sharing exactly what's going to happen in the future and what to do and what your options are. So I'm going to encourage you to stay tuned. Like I said, what we do is we set up high cash value policies to earn dividends. We want to maximize the growth, minimize the death benefit. We want our money to grow. We have companies currently paying 5.75 to 6% dividends. Those will be increasing, folks, because they're highly interest rate sensitive. Historically, average dividend rates are more like 6.5 to 8% is the norm. 7-8% is the norm in a normal interest rate environment, which we're quickly moving towards due to the Federal Reserve. So we fully expect higher dividends as we go forward. So that's what you can expect. All the companies are telling us the same thing. History also shows us the same thing. Secondly, when we want to, if you want to leave the money there and let it grow, great. It's guaranteed. It has guarantees. It's insured. It's tax-free. You have access, liquidity of 50 to 85% of the money day one, depending on how we set it up. Great place to park some money for a while or long term. If you want to park, grow long term for supplement retirement or whatever, great. If you want to park it there for a short while and wait for opportunities, great. At least you're not losing double digits because let's be real, that's the real inflation rate, not the 8.8% stuff we've been hearing from the government lately. At least you're not losing double digit. If you're making 6%, let's say dividend, you're still losing, but not as much while you're waiting for opportunities. It's a great place to park money. Now, when you want to access the funds, you can access them through the bank lines of credit. Current rates, 3.5 to 4%. I already shared with you 5.75 to 6. So keep it simple. Let's say you're earning 6% dividend and you get charged 4% to access the funds. You keep the difference or the 2%. By the way, that's each and every year, and that is on money you spent. This is the takeaway, folks. You get the positive arbitrage. You keep the difference on the dollars you spent. Where else are you going to do that? So if you do take that money and invest in some opportunity when it presents itself down the road, you're still picking up a couple percent on the money you spent. So you're even doing better than you were before, right? That's why your personal bank is so powerful. Now, let's talk about what to expect with increasing interest rates. The Federal Reserve is embarking and is actively increasing interest rate at the fastest rate of the history of the Federal Reserve. That's over 100 years, folks. A year ago, to give you an idea, the interest rates, as I stated earlier, the interest rates for borrowing with the lines of credit, I shared the dividends are 5.75 to 6%, and we fully expect those to be increasing going forward the next several years at least. Those are going higher. The borrowing rates are based on the prime rate, which is posted by the Wall Street Journal each month. And it's the prime rate minus, it's either prime or prime minus 0.5% or prime minus 1%. There's 3 tiers with the banks. and it depends on how much money you put it in, how much funds you have there. Okay, a year ago, prime was 3.25, so the borrowing rates were around 3% because most of the banks had a floor. Okay, they couldn't operate at less than that. The prime rate was 3.25. It is now, as we speak, 4.75 and increasing. All right. The borrowing rates of the bank is prime minus half or 1. So that means the borrowing rates as we speak are between 3.75 and 4.75. So if you're earning 5.75, you're still okay. You're still earning 1 or 2% positive arbitrage on your money as we speak. If you're earning less than that, if you're earning less than 5% on your policy dividends, this is something you should check. All of my clients that I work with today are earning 5% or more. But if you have something from another company from somewhere else, you're earning less, and there's some companies out there that are paying less than 5% dividends even right now, you're losing money if you access funds from it. And I would encourage you, if you've got that situation, contact me and I can show you how to 1035 exchange, non-taxable event, convert that money to that account to a better one to earn a better dividend rate, okay? And grow your cash more efficiently and faster. And if you want to do that, call me, 866-268-4422 or yourpersonalbank.com. Again, 866-268-4422. Now, as I stated, my clients are fine at the moment as I'm recording this. But guess what? Federal Reserve already stated they're going to raise rates next month. And what's going to happen starting in about a month or so, some of my clients, the borrowing rates from the banks are going to start to catch up or even eclipse the dividends. What do we do? Well, there's a solution. And I'm going to encourage you, if you're one of my clients listening to this, as I know many of you do, and I thank you for that, or you have a policy that's earning less than 5.75% dividend right now in 2022, I'm going to encourage you to contact me. Again, it's 866-268-4422 or yourpersonalbank.com. And the solution is this. You can borrow from the insurance policy directly. You don't have to access the funds through the bank. I know we teach that and talk about that all the time, and it works. And traditionally, historically, over the past 40 years, most of the time, it's cheaper to borrow the funds, access the funds from the bank, giving you that positive arbitrage. And the historical average the positive arbitrage has been about 2 to 3% historically over the last 40 years. Well, guess what? We're in unprecedented times, right? As I stated earlier. But there's a solution, so fear not. If you set up one of these new policies that we have, they have a 4% borrowing rate and earn 5.75 dividends. In other words, your worst case scenario, irregardless of how high the Federal Reserve raises rates, you have a borrowing ceiling of 4% with these new policies. And if you're one of my clients, these started in 2022. So if you have a policy through myself or our company or any other place, and it was done in 2021 or earlier, you need to consider one of the newer policies because you want to reduce your borrowing rate. If you reduce your borrowing rate to 4%, and you have your dividend rate at least at 5.75 or higher, you're still getting that 1.75 or more positive arbitrage. So the solution is we need to upgrade you to one of the newer policies with the lower borrowing rate and the stronger dividend rate going forward. If you're one of my clients, as I stated earlier, we gave you the best that was available at the time. Okay? I just did this myself personally, upgrading to one of the new ones because I wanted to increase my dividends and reduce my borrowing rate to maintain that positive arbitrage when I access funds or either now or in the future to take advantage of opportunities or pay bills or do whatever. supplement retirement, you name it. So again, I'm going to encourage you to contact me at toll-free 866-268-4422 or yourpersonalbank.com, 866-268-4422.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And as I stated in the earlier segments, if you've been listening, I'm sharing what to do with your high cash value policy, what to expect, and the solutions, what to do to still maintain positive arbitrage and an increasing rate of return on your money with the increasing interest rates that are happening with the Federal Reserve. If you act accordingly, the increasing interest rates for these policies is very, very good news. In other words, historically, dividends are they've always been highly interest rate sensitive. And in a normal interest rate environment, the average returns is around 7 to 8% dividends. It's been in the 5 to 6% range because of the historical low interest rate environment, the lowest we've seen in the history of our country. That is rapidly changing. So this is a message that's not only going out to everyone who's listening, anyone who's considering a personal bank policy, or anyone who has a high cash value policy, whether you got that from me or anywhere else, and including my clients. In fact, this message I'm going to be sending to my clients. Okay? So you're getting an advantage, I guess, an inside scoop of some of the information that I share with my clients, okay? And like I said, the dividends right now are the products we have available right now are paying 5.75 to 6%. That is increasing. You want to get in one that has the higher dividend rate and will be increasing as as interest rates increase, which they're doing aggressively. The second point of it is the borrowing rates from the bank lines are historically lower than the dividends earned, but we are in unprecedented times. They are based on prime, and the prime rate is rising rapidly. It's currently, as I speak, 4.75, which means the borrowing rates are between 3.75 and 4.75 as we speak. If you're earning 5 to 6% dividends, you're still okay, but soon the interest rates from the banks are going to eclipse the dividend rates, very likely based on what the Federal Reserve is stating. The solution, we upgrade you to one of the newer policies that have higher dividends, currently 5.75, fully expect to go higher in the future, and lower borrowing rates, 4%. Almost every policy I have dealt with any of my clients in 2021 and earlier had a 5% borrowing rate. Other policies, contracts out there done by other people that, most of them have 5% or higher borrowing rates, which means you will not be able to effectively access funds from your policy if interest rates continue to climb. You'll be underwater, in other words. We can solve that for you. You lower your borrowing rate to the 4%. And like I said, worst case scenario, we'll have you to 1.75 positive arbitrage right at the gate. And that will get better as we go forward, as interest rates increase. Contact me at toll-free 866-268-4422 for more information, or yourpersonalbank.com. Again, 866-268-4422. Now, a couple other quick thoughts I want to share. And again, this is kind of inside knowledge that's going out publicly that I share with my clients. Again, the products that we've been dealing with our clients, we offered the best that was available to maximize cash value at the time that this was done. Things change. Opportunities change. Situations change. So I'm going to strongly encourage you to contact me to get you into that better situation. If we take a policy that you currently have, whether we set it up for you or you got it from someone else somewhere else, whether you've had it for a year or 20 years, I don't care. We'll run the numbers, we'll do a comparison to make sure the numbers work. If they do, and 98% of the time they do, folks. When we do a comparison, apples to apples, numbers comparison, We can then do a 1035 exchange, bringing all the cash that you have in the old policy to the new one. You don't lose what you've contributed previously. We can do it on a tax-free basis. Therefore, there's no cost or fee or tax to bring that over if it's done properly, which of course we will do. We will run the numbers, of course. We'll ensure that you'll be in a better position. And then now you'll receive higher dividends, earn more, faster growth, and a lower borrowing rate, which then ensures your ability to maintain that positive arbitrage when you access funds. So if you leave it there and let it grow, it's going to grow faster than what you're doing now. If you decide to access funds, you'll still pick up a couple percent positive arbitrage, basically, or more. And folks, the good news is, the exciting news going forward, if the Fed continues to raise rates as they are fully stating they're going to do, we could very likely in the next couple of years or so see a positive arbitrage situation gap widen even further than the normal 2 to 3% that's historical. Contact me at 866-268-4422 or yourpersonalbank.com for more info. Again, that's 866-268-4422.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is probably one of the most important shows I've done in a while in regards to the personal bank concept. And again, it's dealing with how to navigate your policy and what to expect going forward in a rapidly increasing interest rate environment. The reality is, folks, I'm going to rehash a few things for those that missed it, but if you haven't heard all of this show, I'm going to strongly, and you want to learn more about this, encourage you to go to yourpersonalbank.com. You can click on listen to previously recorded shows, and you'll find this show, the topic that I'm discussing here. You can listen to this. Again, what to expect, how to maximize growth in your high cash value policy, whether you got it from us or somewhere else, going forward with a rapidly increasing interest rate environment. This message is also going out to my clients. So anybody listening is getting a little bit of inside scoop on what I am sharing with my own clients. Quick rehash. We set up the high cash value policies to maximize cash growth, maximize dividends. Current dividends, 5.75 to 6%. Best products available currently. If you have a product prior to 2021, you might be probably 2020, I should say, with my clients. You might have a product with a 5% dividend, but that was the best available at that time. If you got through myself, 2021 or so, 5.75 to 6% dividend. If you got a product from somewhere else, somebody else, check your dividend rates. It's probably that or lower, or you have higher fees. I'll put it that way. If you want a comparison to show which product is earning more cash and is structured to earn more cash, because that's how we maximize setting them up, contact me, 866-268-4422 or yourpersonalbank.com. We'll do a no cost, no obligation, head-to-head, apples-to-apples comparison and show you the difference, show you the numbers, okay? Now, the second step is if you leave it alone, want to let the money grow, and it's growing safely with guarantees, tax-free, guarantee, all that good stuff, with liquidity of 50 to 85% day one, great, no problem. You can let it grow, let it go, and access it whenever you want to. At the point you want to access funds, we usually set up a bank line of credit, much like a HELOC, to access the funds. The cash in the policy is the collateral for the loan. The borrowing rates are typically less than the dividends earned. That has been true for the most part every month for the last 40 years, except 2 months that happen to be equal. Well, guess what, folks? We're in unprecedented times. The Federal Reserve is raising rates at a faster rate than they ever have in the history of the Federal Reserve. It's the most aggressive increase we've ever seen in over 100 years. We are in unusual times. If the Federal Reserve continues to do what they state they're going to do, and I fully believe that will happen, in the next month or two, we should see borrowing rates, prime rates, higher than some of the dividend rates that are being earned. What to do? There's a solution. Stay tuned. Hang on. I'm going to share it with you in a minute or two. Understand, the borrowing rates are based on the prime rate. Prime is rapidly increasing. And the borrowing rates are prime or prime minus 1%. Therefore, the current rates are prime is 4.75. That means the borrowing rates are 3.75 to 4.75 as we speak. Now, that's still below what my clients are earning in dividends, so they're okay. But if the Federal Reserve raises rates again next month, as they state they're going to do, some of my clients, the dividends will actually be less, especially some of my older clients' policies, less than what they're earning. We can fix it. I want you to understand that. If you have a policy from somewhere else, you very likely are earning lower dividends or having more fees. And if you decide to access money from your policy, you're going to be underwater. We can fix that. And how we fix it is two things. First, we want to get a policy that has the highest dividends paying possible and is most likely to increase dividends going forward as interest rates climb. We can get you in a policy that's making 5.75 today and will very likely, highly likely, have more dividends in the future because of the increasing interest rate environment. That's good news. Probably for the next several years, folks. We also want to lower the borrowing rate because we want that positive arbitrage. When we access money, we want to keep the difference, right? The biggest gap we can create, the better. We have policies that will allow you, new ones in 2022, that will allow you to access funds at a 4% borrowing rate. So if you're earning 6 dividends, you access monies from it, and you're charged 4, you're still keeping the difference, or 2%. And remember, that's the difference. That 2% is on money you spent. And that isn't just 1 year, that's every year the rest of your life. Do you want to earn a couple percent on money you spent every year the rest of your life or not? That's what it boils down to. That's the power of the personal bank concept. We got to make sure that gap is as wide as possible. I'm going to encourage you, if you're one of my clients and you have a policy that you set up with me or our company, 2021 or earlier, call me toll free 866-268-4422 or yourpersonalbank.com. Again, 866-268-4422. If you're not one of my clients, we will still offer you the same opportunity. We'll run the numbers and show you how to improve your situation and make your policy work for you. Okay? We can do that. We can fix this. But you need to take action to fix it. Because as we go forward and interest rates increase further, you could put yourself in a situation with one of these policies where you're accessing funds from the bank line or from the policy itself, and you're going underwater because the borrowing costs are higher than the dividends earned. I don't want to see you. You don't have to be in that situation. You don't have to be stuck there, is what I want you to understand. I can help you. So again, whether you're one of my clients, our clients with our company, or with your personal bank or not, we can help you. 866-268-4422 or yourpersonalbank.com. The last thing I want to share, the last few minutes of this show, is why I think this is so important, particularly at this time. I know that we heard from our government and the Federal Reserve and the various people that inflation last year was transitory. Then later they said it was going to be longer, and now they're saying for the next year or two. Folks, the reality is they've been wrong from the beginning, and my opinion is they continue to be wrong and will be for some time. And there's some reasons why. First of all, if you didn't know this, the first half of 2022 was the worst first half of the year for the stock market since 1970. In other words, the S&P 500 fell more than 21% in the first half of 2022, which is the worst period, 6-month period, in the history of the stock market since 1970. Folks, that is a long time, okay? Consumer confidence reading fell to its lowest reading since 1952. Folks, these are historical numbers. These are historically bad numbers. And remember, what's causing inflation? Government spending too much money, which it's continuing to do so, therefore, continued inflation, and limiting energy supply. Basic Economics 101. You reduce supply, you increase prices. Supply and demand, right? Forget the politics for a minute. I know it's hard to do sometimes. This is basic economics. As long as we have low restricted supply, we're going to have high prices, which means we'll have high inflation. And then we have a couple articles I want to share that came out recently from the Federal Reserve. This is the Federal Reserve Chairman Jerome Powell stating, fixing inflation is highly likely to involve some pain for the American people. He's finally starting to speak some truth. Some honesty is coming out. I think he's still understating it, folks. It's going to be a rough ride. The next thing he stated, which is even more disturbing, the Fed chair stated, we now understand better how little we understand about inflation. Folks, that is not encouraging. That is not reassuring coming from the chairman of the Federal Reserve. The problem is, he said, honestly, we had no idea. We had a meeting a year ago, and 34 of the 35 people we filed of professional forecasters told us that inflation would be below 4%. It's more than double that. The problem is they were using something called the Phillips model, Phillips curve model. Even though they had 35 quote-unquote experts, they were basically all using the same computer model, which has been proven to be outdated. In other words, we have overeducated idiots. I started saying inflation was going to be a problem back in May of 2021. If you want to check it, go back to yourpersonalbank.com and listen to previously recorded shows. They're on there on the website. It didn't take a genius to understand we were going to have inflation problems when energy production was reduced and the government started spending a ton of money. But these idiots couldn't seem to figure it out. And they call them experts. So far, they've been wrong about everything. There's nothing they're doing that causes me to think that they're going to be able to solve this quickly or easily. Okay? Again, those two things need to change. Couple of other key points. Soaring inflation is now causing more than 50% of Americans to live paycheck to paycheck. Folks, that's double of what it was a few months ago. In other words, half of Americans are one paycheck away from economic disaster. What's that going to do? That is going to cause further bad news for the economy. We're going to see things like foreclosures and those kinds of bad things, default on debt and things like that, increase significantly in the near future. In fact, he even pointed out consumers in all income brackets, including those who make more than $100,000 annually, are devoting nearly all of their salaries just to pay expenses, with little or nothing left for savings. Folks, that's not good. Next one. 19% of business leaders are optimistic as recession fears loom, which again is one of the lowest readings of highest degrees of pessimism for businesses in decades. Okay? In other words, when you have consumer sentiment at the lowest levels since 1952, you have the worst stock market. The first 6 months of 2022, the worst stock market since 1970. You have some of the highest consumer price indexes and producer price indexes in 40 years. You have 19% of business owners who are optimistic. And then you have Biden come out stating things like, how long is it fair to expect Americans to pay historic gas prices? And his response is, as long as it takes to beat Putin. In other words, he keeps blaming Putin on the price hike. The reality is, anybody who is paying attention knows that about half of the inflation and gas prices had already increased before Russia invaded Ukraine. Yes, it exacerbated the problem, but it's not the cause. The cause is reduction of oil and energy supply and too much government spending. And until we get to the root cause of the problem, we will have higher than average inflation. And the last one is Biden's abuse of Defense Production Act will drive gas prices even higher. He's forcing the business to try to put more effort into green energy, which is going to hurt the energy industry even further. Folks, it's going to be a rough ride for the next year. Contact me at 866-268-4422 or yourpersonalbank.com for more information. I'll help you navigate this, but you got to contact me, 866-268-4422.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.